Hello, everyone. My name is Dan Barnett, and I'm a portfolio manager here at Johnson Investment Counsel. And this is another installment of JIC's Research Edge. Joining me today is Charles Rinehart. Charles is also a portfolio manager here at the firm, and he also heads up our equity income strategy. Charles is going to briefly recap the markets of 2019 and touch upon some of the things we're looking at as far as the economy is concerned. Thanks for joining us, Charles.
Thanks for having me.
I would imagine a lot of investors are looking at their year-end statements today and probably pretty happy in what they're seeing. So can you give us a brief recap of what has happened in the markets last year?
Well, there was a lot to be happy about. 2019 was a year of broad-based strength across markets and geographies. The U.S. was particularly strong. U.S. stocks were up as much as 31% or more. International stocks participated, up more than 20%. Real assets, be they energy infrastructure or broader global infrastructure, were up 20% or more. Even high-quality U.S. bonds, taxable and municipal, outperformed expectations, up mid-single digits or even better. So it was a year really where everything worked, and there was a lot to be pleased about when opening those statements. Now, one caveat to that, the 2019 strength, particularly in the United States, was set up by some weakness at the end of 2018. You may remember that we had almost a 20% pullback in the fourth quarter of 2018. And in periods with those pullbacks, without any type of recession, it's usual to see strength the following 6 months, about 25% on average positive return for the market. This was not a lot different. We had about a 27% positive return in the 6 months following that weakness, which accounted for most of that 30+% return.
So there was a lot going on here in the economy in 2019. Certainly we saw a lot of headlines about tariffs and trade policy, also U.S. Federal Reserve rate policy. So can you briefly touch upon some of those milestones we saw here in 2019?
Yeah, economic policy is always a big deal. There were some unique situations in 2019, notably the trade war situation with China. We saw a significant escalation throughout the year, several rounds of heightening tariff rates on broader and broader bases of goods, starting with industrial products and moving into consumer goods throughout the year, to the point where the run rate of annual tariffs reached about $80 billion. To put that in perspective, that's about 2/3 of the benefit that companies received in the 2017 tax cuts. Now, there were some good news at the end of the year with the phase one trade deal offsetting a small portion of those, really signaling some room maybe for the two countries to come together. But there's lots of room for those tariffs to still continue to go away if there's further de-escalation. You mentioned the Fed. 2019 was a pretty significant policy reversal for the Fed. 2018 was a year of hiking rates. 2019, we saw 3 cuts. That signaled to the market that the Fed was likely to remain accommodative and probably did a lot to fuel that rally we just talked about.
So you mentioned a little bit about the strong stock markets here in 2019, some markets actually being up over 30%. That surely means in 2020 we're going to be down, right?
Actually, I have some good news on that front. We've studied the history of S&P 500 returns year to year, and in any given year there's about a 70% chance that the markets will be positive if you look at history. That percentage doesn't change much based on what happened in the immediate past. So if you look at years just following positive years, negative years, even just the years following the most positive, 20% plus years, still about a 70% chance for a positive return. So there's nothing saying that just because we had a strong year last year, we can't continue to have strength in the near term. The one thing that might conflict with that would be the starting valuation level for the market. Along with last year's strong returns came a more expensive PE ratio. That PE has a long-term relationship with forward returns. So over the next 10 years, if that historical relationship holds, the more expensive PE ratio we have today would indicate a more modest return environment, maybe something in the mid-single digits, which would be significantly less than we had over the last decade.
So now that we're in the later innings of this current economic cycle, what are some of those risks to growth that we're really paying attention to, and how are we positioning client portfolios today to help mitigate some of those risks?
On the economic side, I think we have to acknowledge that risks are just generally elevated. Leading economic indicators have declined really throughout the last year and now are hovering near zero. That's important because it's notably an inflection point. If we see continued negative growth, we'd be in negative territory. If we see a bounce, then things could be quite good. In fact, we've seen 2 bounces off of similar low levels already in this expansion, so there's nothing saying that couldn't happen. Nevertheless, I think the best way to account for the heightened economic risk is to stay disciplined in your portfolio construction and allocation. Make sure you continue to have an allocation to investment grade bonds if that's appropriate for your needs. Those will hold up the best in times of stock market weakness. In terms of other risks, we can't go without saying that this is a presidential election year, already all over the news. There's some very different ideas being debated across the aisles. Some of the common threads may be, some restriction in energy, potentially regulation in healthcare. We're being proactive about trying to avoid those really hot topic issues in portfolios.
Well, thank you, Charles. This has been very helpful. And thanks again for tuning in to another episode of JIC's Research Edge. If you have any questions, please feel free to reach out to your Johnson Investment Counsel team. Thank you.